Hi, this is James Ng with Old Capital, and today we are going to talk about coronavirus's impact on multifamily. We're going to start super current about sort of stimulus package, what's going on with that, and then move into lessons from 1989. So Trammell, which was one of the largest developers and continues to be one of the largest developers, what lessons did their top executives learn from the crash of the late 80s, early 90s here in Texas? And so I'm going to share sort of the top 10 things from those memos. So to start off a little bit about my background, born and raised in Houston, went to school at UT, been here in DFW since 2006, was a loan underwriter from 2007 to 2015 at G Capital. And then the last 5 years have been focused on multifamily loans across close to 125 properties, $750 million originated in the last 5 years. And then also invested in across close to 25 properties in DFW, Austin, and San Antonio as a limited partner. So let's start off with today, right? So what's going on in today's current market? And Pensford put out a great newsletter in the past week about 2008 versus today. So in 2008, it really started with securitizations going bad, that halting liquidity, impacting banks to fail, such as Bear Stearns and Lehman. And then that impacted borrowers' ability to borrow, and that impacted tenants, and the economy halted. And that really was from February 2008 to February 2010. The economy lost 8.6 million jobs. And it really took a while. Total stimulus across 2008 to 2010 was $3.1 trillion. Okay. And then let's compare that to today, right? So the economy is halting because of all these shutdowns. Thus, tenants aren't paying, borrowers can't make their mortgage payments, which is impacting banks, and that's freezing up liquidity and thus securitizations. And then in 2020, we lost 3.2 million jobs in 1 week. People are expecting another 3 million plus this week, and potentially could lose more jobs in 1 month here than the entire financial crisis. And so this is where the government's trying to step in. Here's a small snippet from sort of CMBS loans, which is, all commercial property types. Right now the delinquency rate is like less than 1%, but I think that's about to change unless the government steps in for these borrowers. And so what is the government going to do, right? So the government has essentially said, all right, let's send out everybody money. And they're doing this through a $2 trillion package, individuals, big corporations, small businesses. We're going to focus on the individuals here on this slide, and individuals getting $1,200, married couples filing jointly up to $2,400, and then you're getting $500 for each kid based on your income, so up to a certain amount, and then it runs out. So essentially, the government's stepping in and saying, "Look, we're going to put the money in the tenants' hands. They can pay our borrowers. The borrowers can pay the banks, and that's going to provide liquidity and securitizations." But Pensford went back and quoted a Wall Street Journal article back from 2008. And essentially, when we sent people money back in 2008, they spent it on food, medicine, and then shelter being more towards the end. But I don't think there was any moratorium on evictions. So that might change people's perception on whether or not they need to pay for shelter. And so a third was spent on essentials, but 2/3 was essentially saved or used to pay down debt. So this is where it gets a little bit interesting. This is newer, is for small businesses. So they're going to have $10 billion for emergency grants and also $350 billion for small businesses in forgivable loans. And so this is the best snapshot that I've seen between the two programs, that are the Paycheck Protection Program and the Economic Injury Disaster Loan Program. The Paycheck Protection Program seems a lot smaller. Its max is 2.5 of your monthly payroll, and then it is forgivable. Whereas the Economic Injury Disaster Loan is up to $2 million, but you're gonna have to pay it back. And so Paycheck Protection Program and this Economic Injury Disaster Loan, depending on how you're set up as a multifamily investor, you could qualify for some of these. The official programs have not been rolled out. It's supposed to be rolled out this week in terms of applying, but this might be another option instead of just going to a straight forbearance if you need the money to support your property due to low collections. So from action item standpoint, inform your tenants. I've seen general partners put out memos to tenants about, look, these stimulus payments are coming, $1,200, $2,400, and unemployment's been expanded. So definitely, get in line and make sure your tax returns are filed and the government has a way of connecting with you because these payments are coming. Number two, incentivize collections. Like we've said all along, April and May. Eviction courts, you're not going to be able to do it. And then this new stimulus act also potentially put out 120-day sort of waiver or moratorium on evictions. And so once the stimulus goes into effect, there's going to be 120 days of basically no evictions. And then look at your balance sheet, right? So make sure your cash reserves are there, look at your forbearance options, and then also look at these government loans on the SBA side. All right, so here, this was posted about last week on 10 lessons from Trammell Crow. So, they basically sent out a memo to all the executives and said, look, we just went through one of the biggest crashes. What were some of the things we learned in the tough times? And what are the things that we should have known in the good times? And so I pulled out sort of 10 lessons and sort of summarized them here for you. This was across like 100 pages of memos. So in the tough times, right? So we're entering tough times. Hold more cash, right? So very few partners were willing to put cash back into projects after distributions were made. So if you send out the money, it's very hard to get it back. But if you articulate to your partners why we are holding cash, they're usually fine with that because it's protecting their investment. Cash is king, and failure to retain cash makes you not be able to capitalize on buying opportunities. So the buying opportunities are coming in this downturn. Some people aren't going to make it through this, and there will be buying opportunities. So you have to be able to retain cash. Number two, negotiation. Document everything, right? So when a deal goes sour, memories become short. And so document everything. So whether that's your forbearance agreements, whether that's your deals with individual lenders, document everything. Mistreating the brokerage community on negotiation. Mistreating the brokerage community, you may win the battle, but you can and potentially will lose the war. So here, a lot of times, brokers are going to be your best friends, right? So you have to make sure you treat them correctly and don't let one deal get in the way of a very long relationship. Debt. So don't deal with second or third tier lenders to save 0.1%. When times are tough, good relationships help. So right now, this is the time, right? So where you have maybe went to a smaller bank or a lesser known bank, now you don't know how they're going to react in this time. And so remembering that choosing your lenders during good times and bad times are very important, because this is now the time that you're going to the lender sort of with your hat in your hand saying, look, if my tenants don't pay, let's work out a deal here, whether that's forbearance or putting it on the back end of these deals. Whereas some lenders are going to say, look, this is the loan agreement, you owe us the money, and we're going to foreclose on you. Timing. So don't buy too soon when things are going down, right? So let this thing play out for a little bit. This connects to the last one, but when you bottom fish and don't have staying power, you turn into fish. And so essentially what that means is, look, if you think you're at the bottom, but it's, 3 more years of this, then you don't have the staying power, whether that's cash in the bank or investors to back you, then you're eventually going to turn into fish and not be able to make it through. And another thing on timing is don't be too slow dropping rates in a declining market, and don't hold out for premium rents while the market is leading with concessions. So Trammell Crow was more of a developer, more of a industrial office retail builder. But the same thing holds true for multifamily, in that if you see rents dropping in your market, occupancy is key right now. So I'd rather have someone in there for $950 versus a vacant unit right now. If your market rate was $1,000 or $1,050, but now all you get is $950, I'd rather have that guy in there for $950. And then acquisitions, look for value in the down market and look to replacement cost versus purchase price. And the project should work at the current market or even down by 10%. So these are in tough times: cash, negotiation, debt, and timing, and acquisitions. And then let's go to the good times. So these were the lessons that I pulled out. Okay, acquisitions. Do fewer deals and do them better, right? So a lot of people got caught up in doing more and more and more and more deals, but then sticking to your yield and profitability requirements, you probably would have done fewer deals. and don't focus solely on the future, the next deal, but have prudent asset management. So the people who bought a deal, did the rehab on the deal, made sure it started performing and got stabilized before moving on to the next deal. That's what you should be doing in the good times. Portfolio management. So sell more product in good times, because when the market becomes soft, there are no buyers. Don't hesitate to sell at a fair price today, because you can get more tomorrow. One way to stay financially healthy is to sell too soon. And so I think a lot of people, they waited a little bit too long to sell in the good times, and the market just became soft and there's no buyers right now. And so in the good times, and we will return to good times, is making sure that once your property, whether it's 2 years, 3 years, 4 years into a deal, it's time to sell. And selling at a fair price is a lot better than not being able to sell. Number 3 is focus. So don't let success lull you into a sense of complacency. I would say this is more like trying to have a magic touch, thinking that everything you touch turns to gold. And another thing on focus, don't drift away from direct contact with the market and become unduly influenced by staff and press. And then be in the field, near the tenants, near the projects, near the markets, and away from high-rise rents. And so this a lot of people in Trammell talked about this, but it's almost like the ivory tower, right? So they signed an office lease, in downtown Austin with super high rents at the top of the market, and they just couldn't get away from it. And then, their projects were really, on the ground, industrial projects, office projects. And so being in the field near the tenants, that's the best way to see some of these changes coming up very quickly. And then in debt, so move to non-recourse as soon as practical. Don't take more equity to sign full recourse, and never finance long-term assets with short-term debt. And this was a big deal. So developers almost always have to sign recourse. And as soon as you could move to non-recourse, it was super practical. But a lot of times the executives didn't do that. And they even took on more recourse in order to get more equity. So whether, instead of getting a 50-50 split, they might have got a 60-40 split, but they had to sign full recourse. And almost all those guys regretted that in the downturn. And then in terms of your team, so stay lean, even if you can afford to get fat. Develop bench strength. One superstar leasing agent is of greater value than an unlimited number of mediocre performers. And this really talks to working with the team you have and really only hiring when you absolutely need to, because the market can turn so fast, and it's so much more difficult to fire someone in a market like this in a correction. And looking for those superstars, a person who can lease a unit and really get after it in terms of whether that's the leasing agent or the property manager on your property, is of great value. So those are my lessons from sort of looking at the market today, but then also looking back 1989. Guys have been through this. These are going to be tough times for the next, whether it's months or quarters or years, and then moving into the good times, but remembering those lessons. So if you want to set up some time to talk with me, you can complete your personal financial statement, send me an email, and we can discuss buying, selling, or refinancing your next multifamily deal. And if you haven't listened to my Multifamily 101 series, that is also available on this channel, and you can start watching that now. Thanks a lot.